Good morning and happy Friday to you. My name is Alex Mathew and this is all you need to know on NDTV Profit. We're here to tell you everything that you need to know before you start your day. Let's start with the headlines. US and UK launch airstrikes in Yemen, heightening tensions in the region. Meanwhile, Iran seizes an oil tanker. Prices of the commodity rise marginally. US inflation rises more than expected in December to 3.4%, higher than expectations. Bond yields fall after choppy session. Equity futures, meanwhile, trade flat. Asian markets trade mixed this morning, but Japan extends gains, up over 5% for the week so far. Infosys disappoints on revenue and guidance in Q3, but TCS surprises with better margins, albeit muted revenues. Prime Minister Modi will inaugurate the most awaited Trans-Harbour Link Road in Mumbai today. Now, the top story of the day has to be the fact that US President Joe Biden, not too long back, said in a statement that the US and UK conducted strikes against a number of targets in Yemen used by the Houthis to endanger freedom of navigation in one of the world's most vital waterways. Those are his words from the statement. At the end of that statement, he also sent out a warning that he would not hesitate to direct further measures to protect his people and the free flow of international commerce as necessary. Meanwhile, Iran seized an oil tanker off the coast of Oman, and that has also caused a heightening of tensions. Oil prices have only risen marginally, though, on the back of that action, with Brent trading at very close to that $79 to the barrel mark this morning. Now, another big development overnight was the US inflation data for the month of December, which led to some disappointment. The consumer price index increased 3.4% in December, and that was the most in 3 months, according to government figures. It also rose by more than forecast on a sequential basis. Core inflation, more importantly, has remained sticky at 3.9% and, in fact, has come in ahead of expectations as well. To tell you how this changes the expectations of Fed action and also how global markets are likely to react in the near to medium term, I'm joined by Audrey Goh, who is head of asset allocation and thematic strategy at Standard Chartered Wealth Management. Thanks so much, Audrey, for taking the time this morning. What did you make of the latest CPI data? Does it change your projection for action by the Fed in 2024?
Well, I would say that it's a rather mixed set of data from the inflation print perspective, because if you look at headline, clearly it's picked up, so that's not great. But from a core inflation perspective, that is relatively stable. In fact, it moderated slightly lower to 3.9%. And if we were to take a deeper look into super core inflation, or rather core inflation, excluding shelter and excluding transportation or used vehicles, actually the pace of price increase has been quite muted, just under 0.2% on a month-on-month basis. And on a year-on-year perspective, it is actually closer to 2.5%. Which is quite close to where the Fed's preferred target rate is. So in other words, if we were to exclude shelter, which is a very lagging indicator, as well as used car vehicle, actually core inflation will be closer to about 2.5%. So I see that as still largely tracking what we expect in terms of a continued moderation in inflation as we progress through this year. Obviously, some indicators are more lagging, which is why we are starting to see that into the headline as well as the core print a bit slower than expected. But then it doesn't really change our outlook of moderating inflationary pressure, which would then allow the Fed more flexibility in terms of its monetary policy over the course of this year.
What's your base case scenario then?
Well, our expectation is the Fed will start cutting rates sometime by the middle of this year. And we are expecting a total of 5 rate cuts, which is a bit more, dovish compared to what the Fed has penciled in, which is 3 rate cuts in their dot plot back in mid of December. And in our expectation, we believe that the U.S. economy is rather slated for a soft landing scenario, because we've got both moderating inflation, but at the same time, growth, consumption, labor market is actually holding up pretty well, although they are also moderating at the margin. So net a soft lending scenario, which should augurs well for both bonds as well as equity markets.
Okay, so therefore, and just to take that a little further, we saw a little bit of choppiness in the treasury markets overnight, but you saw the bond yield once again for the 10-year drop below 4%. Do we see that structurally moving closer to that 3.5% mark? When do you see that happening? And what are the implications for emerging markets? How do you view India?
Okay. So we do expect that in the near term, we may see some short-term push higher in bond yields, because let's also not forget, bond yields have come down very significantly in the last 2 months of November and December. So what this means is some form of consolidation from here shouldn't really come as a surprise. And from our perspective, we actually believe that the 4.05 level, which is on a 10-year US 10-year Treasury yield, is actually quite a strong sort of resistance for it to breach higher, and followed by a subsequent resistance at 4.25%, which is why, from our perspective, we continue to like developed market sovereign bonds, and we expect easing monetary policy to drive overall bond yields lower to about 3.25, 3.5% thereabouts, where the 10-year bond yield are concerned by the end of this year. From an Indian market perspective, I think India is one of the markets that we like on a structural basis. For that matter, we actually like Indian bonds much more so compared to Indian equities, given that the Indian equities valuation continue to look quite rich. And then from a bonds perspective, at least on the INR bond perspective, we do believe that from a peak in policy rate hiking, plus together with inflation, together with a rather good decent set of current account sort of balances as well, should augur well for the local currency bond market in our view for this year.
All right. Thanks so much for joining us this morning. Pleasure speaking with you. All right. That was Audrey Gore talking about the likely move for international markets and bond yields, in fact, going forward. Let's turn to the Indian equity markets then and talk about the F&O Qs this morning, and also what Agam's penciling in for the most active sector. I guess to a certain extent one could assume, and assume correctly in this case, that IT will be in focus. But what are the cues that you're focusing on, Agam?
Well, ITs will certainly be in focus, Alex, and that's going to have an impact on the benchmarks as well, because they're two heavyweights, TCS and Infosys. Yesterday, it was a quiet day of trade, and we did end up in the green. And well, that said, we did see about increase of 2% in open interest as far as the index futures go. The Bank Nifty as well did see a little bit of more traction there. So let's pull up the Bank Nifty, and that should come up for you on your screen. Again, marginal gains coming in, but a 4% increase in open interest. As far as the option space goes, and in terms of your open interest, we move on to a new week. And this week is going to be a little more volatile on account of earnings. And because of which, we're expecting the range to have broadened from a 300-point range that we were working with yesterday to a 500-point range at the moment. And the range doesn't really change that much. It is 21,500 on the lower end and 22,000 on the higher end, while yesterday we did see a lot more traders sell that 21,700 straddle, which is bang in between that range that I'm talking about. Let's move on and talk about stocks then. And we did see longs in HDFC, AMC, Gujarat Gas and Torrent Pharma. Polycab took a huge knock yesterday. The question is if we can see a bout of short covering, even though we don't have too much in terms of fundamentals at this moment, and certainly no clarity with respect to its challenges with respect to the IT department. But a bout of short covering for Bajaj Auto, Birlasoft, Exide, Tata Power and Coforge. Keeping an eye on all these names as we move into trade today. But as you pointed, Alex, we will be watching out for the reaction of the IT sector, not just TCS and Infosys, but potentially all the other constituents as well.
Absolutely. Let's, in fact, focus on that. Thanks, Agam, for bringing us those details. But let's focus on the earnings that Agam was just pointing out. The IT majors, TCS as well as Infosys, kicking off the earnings season yesterday. And TCS, in fact, beating expectations on the margin front. We've got Sajid to tell you about the key numbers to watch out for in this report. Take a look.
TCS came out with good set of numbers, pretty much in line with street expectations. The revenue came at 1% growth on a constant currency level in Q3 for them. The ground situation continues to be stable as per Kriti. They continue to say that demand is still little cautious on the demand front, and they don't know when and which quarter demand is expected to pick up from there. The markets are volatile, and despite this headwind, they've been able to get a TCV or total contract value of $8.1 billion, half of which is coming from the US markets. TCS has been guiding around $9 to $11 billion of TCV in the second quarter. It's a bit tad lower than that, but given the kind of headwinds, they're saying that this is a good TCV coming in for them. And these entire contracts which have come in FY24, they have already started performing, and they've been yielding revenues. They continue to reiterate that some of the orders from FY20 to 22 is where the trouble is, where the orders have either been stalled or reprioritized, or there have been a change in technology platform, and so the priorities or the returns for the clients have come down, and so they have gone back on some of the orders there. UK continues to be good performing market for them, though Europe is weak. The CEO NG Subramaniam says that they're seeing some kind of green shoots coming in that market. BFSI, though it was a degrowth quarter for them, it continues to be they continue to get orders from the BFSI. They expect BFSI to pick up once some kind of US recovery is seen in that market there. Margins was a surprise for the street, 70 bips up in Q3 to 25%. This is on the back of another 101 basis points up in Q2. They have this aspiration margin level of 26 to 28%, and 25% is a good set coming in Q3 for them, and that would be a positive for the street going forward. This is primarily led by reduction in subcontracting costs and some of the forex gains that they got during the quarter.
All right, let's focus in on Infosys as well, where the revenue and PAT both declined in the third quarter on a sequential basis. We've got Tushar to lay out why that happened and what the fine print is. Tushar, what can you tell us? Morning.
Good morning, Alex. So the first things that you have to consider about Infosys is the guidance that the company has given. The guidance has been tightened to a narrower band of 1.5% to 2% for the fiscal ending March 31st, from 1 to 2.5% that we saw from what was guided by the company at the end of the second quarter. So first, a key highlights. What we have to remember in the case of Infosys here is that there were no shockers. In the last 1 year, there were 2 quarters where Infosys results disappointed. There were no disappointments here, and that's why at least the ADRs are reacting positively to that. So the numbers first. Q3 revenue is down 0.44%. EBIT is down 3.78%. EBIT margin is about at 20.50% from 21.21%, and net profit is also down 1.64%. So all reds there, but there's still no shockers so far as the company is concerned. So 2 pointers here. One, from the company, deal making. Deal making is still elongated. Digital programs are something clients are not looking at today's climate. So discretionary deals are still absent. TCV is still high at a robust $3.2 billion. For the 9 months ended December 31st, Infosys is at something at about $9.7 billion or something. Infosys also focused on how the global macros have affected clients' decision making. The company, however, is still confident of achieving operational profitability of 20 to 22%. That's despite a decline in the EBIT margin of about 70 basis points in Q3. So wage hikes have eaten into the margins. Furloughs have impacted the operational efficiencies that the company has achieved. But the headcount reduction that we saw again, that's about 6,100 employees actually left the company, a net of them. That as well as cost management that the company has done is shoring up the margins. We are also getting some early indicators from analysts. Jeffrey says that the net new order book is impressive with growth guidance narrowed. Headcount declines suggest that demand is unlikely to recover anytime soon. Margins are still healthy. FY24 guidance is achievable. HSBC is saying that Q3 has not impacted FY25 EBIT estimates. They prefer Infosys on cheaper valuations and faster growth potential. DAM Capital says that Q3 is a third consecutive quarter of guidance cut. Ramp up in deals will start only in FY25, given the wins that they have so far this year. the increase in utilization levels should further support margins in FY25.
Right.
So FY25 may see much more positive news from Infosys.
All right.
Alex.
So we already saw Infosys stock lose a little ground in trade yesterday. Let's see how that pans out today. But the other two that we're focusing in on from the frontline pack is HCL Tech as well as Wipro. What can you tell us about the key figures to watch here?
So first, let's talk about HCL Technologies, which is the third largest IT company. What we have seen so far in the case of TCS and Infosys is that seasonality is at play, where furloughs have impacted the numbers so far. Seasonality is also at play at HCL Technologies, but in a positive way. So HCL Technologies is a products and platform-focused company, and this is the quarter where they actually start making money. So what we're expecting is a strong revenue pickup from HCL Tech at about 4% in constant currency terms. The implementation of the Verizon deal, that's $2 billion deal that HCL Tech struck last quarter, have also started ramping up. There'll be continued Q-on-Q growth in the ER&D business. Remember, HCL Tech also struck a deal with a company called ASAP, I think, if I'm not mistaken, if I'm on those lines. So that is also ramping up. There's also the products and platform growth will offset the margin hit due to the wage hikes that went out in the October-December quarter. The TCV value may moderate but still will be almost at a record $3.7 billion in Q2. Now, what do we watch out for? Is the Verizon deal ramping up as planned? The prospects of the auto R&D business after the HCL Tech ASAP deal that happened. What is the outlook for FY25? Also, there was a deal that was scrapped during the third quarter, that with State Street. That impact also has to come. As for Wipro, the pain is only seen getting exacerbated in the future, in this particular quarter. Revenue is set to shrink even further. It's seen at about 3.3% quarter-on-quarter decline, which is in line with the guidance that the company gave in the previous quarter at minus 3.5 to minus 1.5%. The EBIT margin for the IT services vertical will contract by 50 basis points. Salary hikes, lack of operating leverage will also weigh on the profitability. TCV, again, what we have seen with its peers so far, deals will still keep coming in, but their conversion into revenue is still a challenge, like with the larger peers. Now, what should investors watch out for? The margin impact first. Are they able to maintain their profitability? They have been able to do so far, but will there be an erosion now? So the impact of the senior level exodus, we have talked about this in our previous stories and in previous chats, that there is a bunch of people have left Wipro since the new CEO Thierry Delaporte took over in 2020. There are a lot of restructurings that has the senior management spooked. So much so, the CFO, Jatin Dalal, about 2 decades left during the previous quarter.
Right.
So what is the sentiment here? That's what we have to watch out for.
All right. Thanks so much, Tushar, for laying that out for us. Clearly a day that will have IT in sharp focus. We have to slip into a very quick break, but there's more stock-specific action on the other side, so do stay tuned. Welcome back. You're watching All You Need to Know. Let's focus in on the stocks that are in the news. We've got Mika to tell you about a few of them. Morning, Mika. What's on your list?
Morning, Alex. So first, let's start with the companies on the back of business updates. We have Ugro Capital, who released their Q3 results. Now, sequentially, the overall assets under management were up 10%, while gross loan origination was up 12%. The liability profile remains diversified, with banks and NBFCs contributing 43 to 10% of their liability mix, where the rest are capital markets, DFIs, and FIIs. And the company is also on track to achieve the stated business target of 50% of book AUM proportion. And it also got the grant of the certificate of registration for carrying out a factoring business. The period of the registration is without limitation, and the company wants to cater to the MSME credit needs of India, and they will explore opportunities via the TREADS platform. Then we have a Mahindra & Mahindra, where the Indian-Japan fund is to invest 400 crores in Mahindra Last Mile Mobility in one or more tranches. Now, the investment values the company at 6,600 crores, and this will be India-Japan's fund's first investment since its set up in August 2023. Mahindra & Mahindra will also invest in Mahindra Electric Automobile with for 630 crores, and this investment is via a rights issue subscription, and it's to fund their business operation requirements. And then we have Container Corporation, which posted their Q3 physical volumes, where total volumes are up 6% on year. We have New Gen Software Technologies, whose record date for the bonus share issue is today, which is Jan 12th, and the bonus ratio is 1:1. And then finally, we have Edgy Infra, which is declared as the L1 bidder for Central Railway, and is going to construct a new BG line in this Central Railway, and the project cost is set at 740.54 crores, and the construction period for the same is 30 months.
All right. Thanks so much, Mihika, for bringing us those details. Let's focus in on a few more stocks that are in the news, and one of them is Polycab. We've got Harsh joining in. Harsh, this is a stock that was beaten down yesterday. I believe there was a statement that was sent to the exchanges post-market hours. Let's start with that. What are they saying?
Well, yes. So what Polycab seems to be suggesting is that there was, of course, a tax search, but after which they've received no intimation from the tax authorities, so they're awaiting that, and therefore they're not even sure whether the press release made by the income tax department is relating to them or not. Of course, there was a block deal on that as well, and we will cover that in greater detail. But we had TARC Limited launches 1.7 million square feet of luxury residential project in New Delhi. Gross development value is roughly 4,000 crore. You have the likes of a Tata Power in focus. Renewable energy arm of Tata Power has signed an MOU with the Gujarat government, developing 10,000 megawatt of renewable energy projects across the state. We have the likes of Bansali Engineering. They've gotten environmental clearance. Two reasons for which their capacities will go up. One is the sand resin, which the capacity goes up from 2 lakh to 225 TPA. And for the ABS resin, the capacity goes up to 2 lakh TPA. So expect that expansion to start to kick in. Capacity, we had a QIP price at 251.65, 200 crore QIP, 12% discount to yesterday's CMP. You have HUL also in focus. FMCG distributors are set to boycott HUL products in Maharashtra, starting with the Taj Mahal tea. Boycott will be carried out largely because there are new margin structures, and these distributors are aggrieved by that. Strides Pharma, we had a step-down subsidiary which agreed to sell 100% stake in Eris Pharma at 200 million euros. Last off, we had the likes of Basel Projects. They've received a LOI for supply of plant and installation services, transmission lines from Tata Power for 488 crores. So keep all of those on your radar.
Absolutely. Thanks so much, Harsh, for bringing us those details. Now, brokerage report to tell you about Morgan Stanley has maintained an equal weight rating on HDFC AMC with an updated target price of 3,000 rupees. Mahima is joining in to give you some perspective on the latest. Mahima, strong results, if I remember correctly. What else is Morgan Stanley talking about?
Correct, Alex. As you rightly mentioned, strong results. Morgan Stanley has maintained an equal rate with a target price of 3,000. So they've increased their target price from 2,800 to 3,000. They've also trimmed their FY 24 and 25 EPS estimates driven by higher tax rate. However, their AUM forecasts remain high on sustained growth of SIP inflows and strong markets. They've raised their target PE price target to reflect their near-term momentum and the sentiment of the markets. They remain equal equal weight given the structural pressure that is there on the current equity yields, and they expect a low double-digit growth in terms of long-term EPS CAGR. So this is overall what Morgan Stanley is saying about HDFC AMC.
All right, thanks so much, Mahi, for bringing us those details. And that brings us to the end of this particular edition of All You Need to Know. There's clearly lots more that you need to focus on, starting with the details and the analysis of the fine print of the two IT majors that reported their results, and also understanding what the management commentary means for the path ahead. All of that is lined up in just a short while, and this is NDTV Profit.